Hello everybody. So for the first time ever, I actually have somebody here sitting with me in my office live. So this is very, very exciting. So this is Emma Stevens. She is mortgage broker and one of my very, very dear friends. So we've worked alongside each other for 15 odd years. So yeah, really excited to have her on the show, and she's based here in Sunshine Coast. Obviously we're very summery because it's beautiful here today. So Lexi is still on her cruise. So next week, Lexi will be back. But yes, on this episode of Frankly Finance, we're going to be talking about mortgage broking, loans, all of that kind of stuff, and picking Emma's brain. So for the people that are watching live, if you have any questions, please chuck them in the chat and we'll put Emma on the spot. But to kick it off, why don't you tell us a bit about you and your career and how you came to be a mortgage broker?
Okay, so hi everybody. Like Gemma said, I'm Emma, and I will start with my career where I've come from. So as Gemma said, we've known each other for almost 15 years. I was with Commonwealth Bank for almost 20 years and started at the very beginning, which was a teller in a country branch, and worked my way through all the different roles in retail banking, which brought me to an opportunity in life where you decide, do I want to work this hard for someone else, or do I want to work this hard for myself and have the flexibility to enjoy my family at the same time? So that was the reason I became a mortgage broker. So 3 years ago, started my business right at the beginning of COVID. And yeah, it's been a very interesting, no doubt, challenging time, as it has for everyone else. But yeah, wouldn't have it any other way.
Cool.
What else do you need to know?
So can you tell us what your favourite thing about being a broker is, and then what you don't like about a broker?
Okay.
There's always something.
Okay, so favourite thing about being a broker, of course, is what a thrill it is to be able to help someone, get their dream home, or whether it be their dream home, help someone build financial security for themselves. So it's not just about buying a house, but it's been able to provide so much more, which, is why we're here today talking about finance, is, helping people build wealth for their future. So yes, without a doubt, making that phone call and telling people that they're approved and seeing them celebrate on settlement day is definitely a massive high. And in particular, helping women. That's the absolute passion.
Yeah, that's like your niche too.
That's my niche.
That's where you love.
Definitely. Moving on to what I hate, it's an extremely emotional roller coaster ride. So, there are some people who are very good at, I guess you would say, separating their feelings from the transaction or the overall relationship. But for me, no, I definitely ride that wave, and sometimes, not always, are you able to see it through. But the hardest thing about the job is, is definitely, I wouldn't say stressful, but it's definitely, you have your highs and your lows. So yeah, when the lows are low, they're low.
Just like when we'll be working together and she'll get an email of like an approval, and it'll be like, oh my God. Yes, and then there's one will come through with like a condition you are in your customers. Like every one of them actually matters, right? You're
Absolutely.
Not like tick and flick, it's not just another number, because you're literally like there for them, going to bat for them with the banks.
Totally. Look, I'm not someone who lets things go easily, and some people say knowing when to quit. For me, I just keep on going. So when that happens, it's not always the outcome that you want, but yeah, definitely.
And as we go through more on like what a mortgage broker does versus a bank, we'll get into it. Oh, my camera just... Oh, sorry, we just changed cameras and this one's all grainy. Let me see what's going on here. Anyway, what I love about mortgage brokers, while I fix this, sorry guys, is that like you have the relationship, right? Like you actually go and you then go on the journey with them with the next house and stuff. It's not so transactional when you go into a bank and you might see somebody different every single time. Well, like your mortgage broker becomes part of your like inner circle with your finances, right?
Absolutely. Look, at the end of the day, there is transactional and there's understanding someone's absolute needs and goals and where they want to go in life. And, that's exactly what I talk to my customers about. It's not about what we're doing right now. It's about really getting in and understanding, what is it that you want in 12 months' time, 3, 5 years' time, 10 years' time, and being able to look at ways and strategies to helping them achieve those goals.
Love it. Okay, cool. So I wanted not to focus too much on first homeowners, but we will, of course. But yeah, I wanted to talk about like investors and stuff as well, because I think lots of information is out there around first homeowners. So let's talk about investors at some point as well. But what would you say like the timeline is, or what would you recommend the steps people take if they're going to get into their first home? Like, yeah, how do they map out when they start doing stuff?
Well, as soon as you think about the fact that you'd like to purchase, you start straight away. So the number one thing that you do is, I would definitely be having a look at your credit score and understanding, the overall history of how you've been managing the existing finance that you've had. So that could mean, you've got a store card with Harvey Norman because it went down to buy a computer for work or study. So that's the number one reason you should check your credit score, because more often than not, the one time that we don't check the credit report and people think they don't have anything, boom, the Latitude card.
So I've never got a credit report on myself. So if you get it, what does it look like? You order it online, and will it actually say all the active stuff and all the applications?
So, okay, so we had this massive transition, as with everything's going online. So, banking, MyGov, government, everything's going online these days. So your history is now what we call, consumer credit reporting. So a few years back, Commonwealth Bank, which is where we were working, and a number of other main institutions all transitioned their data to consumer credit reporting. Pretty much most other finance institutions and utility companies are all on this reporting tool. So once upon a time, when you got a credit report, it was through a completely different company, Bancorp or something like that. I can't even remember now, but now it's called Equifax. So there's lots of different other things on the internet around get your credit score, but Equifax is the actual consumer credit reporting tool that all the banks, or the majority of the banks, actually use, and they look at that before they do anything with your application. However, there are some lenders who actually don't look at that report whatsoever. So what it is, you can get one free one each year, so you can go in and check the health. It's not a bad idea to check it anyway, because you just want to make sure that someone hasn't fraudulently hacked your ID.
So if somebody had taken your ID and they were looking at getting personal loans or whatever, you'd see it on your credit report.
Absolutely. Or an inquiry. So you just never know, right? There could be an inquiry and you're like, hang on a minute, I never knew that I inquired for something. So the credit reporting tool is showing, so once upon a time, if you had a bad hit against your file for something that wasn't really your fault, but you've been an excellent tenant, utilities, everything's been paid on time. The great news is the banks can see that. They can see this really good history, and they weight the score on how well you pay things on time and how regular, and if you paid in full, and so the reporting tool shows, okay, what inquiries are there, how many, because sometimes having a lot of inquiries can be an issue with some of the lenders. But again, the number one thing is they're looking at that repayment history. So I think that could be the first thing that you could do, starting from the day that you decide, hey, I'd really like to do this. Secondly would be make a phone call to a mortgage broker and have the conversation, because a lot of people think they're a long way away from being able to make this come to fruition. However, with all the other incentives that are out there at the moment, or being able to use parents as additional guarantors, there are ways of being able to get into the market sooner.
Well, there's all those schemes there's first home owners, there's family ones, single parents, that you can get in with 2-5. So there might be all these deposits.
5%, there's still first home owners grants if you're building. And look, I think at the end of the day, some people who hold off thinking, I'm not quite there yet. Those people that we sit down and talk to, that they are suddenly surprised. They're like, wow, I had no idea. Because
I think the big misconception is everyone just hears you've got to have 20% or whatever. So they're probably thinking, there's absolutely no point speaking to a mortgage broker yet, because they'll just be wasting their time. I'm years off. Whereas if you saw them straight away, you could map out, how far off am I? How much do I actually need to save? How quickly am I going to be able to do that?
Exactly. Kind of look, even it's understanding what your background is. So you might not have the 5% saved, but yet are kind of eligible for the 5% first homeowners incentive, because you've been paying X amount in rent, or you've been on a lower income, but you've been studying, and all of a sudden now you've jumped up to this much bigger, and an opportunity has risen. So there are certain ways, that's where a good mortgage broker, understanding your history and being able to explain that to a lender, you don't necessarily have to wait as long as you think.
I think people are always really surprised. One of the questions that we have in the chat that I wanted to make sure we were going to get to anyway, which I love, Marie has said, how do mortgage brokers make their money? Is it commissions from the loans? So can you talk about how mortgage brokers make money, how banks make money, and that kind of stuff?
How do we make money? Great question.
Everyone needs to make money.
Great question, Marie. And what should happen is, when you do speak to a mortgage broker, as soon as I speak to someone, I send out a document called my credit guide and customer charter. And in that document, it actually outlines how the mortgage broker or how I'm being paid. So there are a lot of mortgage brokers out there who charge what you call a fee for advice. So, you know, it does take a lot of work working on files, and not always do they go ahead, or for whatever reason they're quite
So that's
complex.
like an appointment cost, is that right? Regardless if you go ahead with them or not.
Yeah, not even an appointment cost. It's a cost for doing the application.
Oh, okay.
Yeah.
So not just that initial chat.
No.
But if they were actually going to do work for you.
Yeah. Same as back in the day with financial planning, you used to take a certain amount to go away and do all the research.
Yeah.
Because it does take time. So in my world at Mortgage Choice, no, we don't charge a fee for advice. So how we are paid is depending on the bank. Every bank or non-bank lender has a certain amount that they pay in upfront commission. So upfront means when the loan settles, you get the loan amount, you times it by whatever their percentage is. So it ranges anywhere from 0.5 to 0.8. Generally speaking, I always average it around 0.6 because again, every bank pays differently. So that's on the loan amount. And a percentage of that, depending on the mortgage broker, goes to the aggregator. So for me, some of that goes to Mortgage Choice. And then, so how we sustain this ongoing is that we get a trail. So generally speaking, it depends on how long that loan has been with that bank. So it gets higher the longer it's been with the bank. So they've been rewarded for keeping the business there. But, you know, generally speaking, it's around that 0.15 to 0.25% ongoing.
So the broker's getting paid initially when they get the loan through for you and you get in your house, and then for however long you keep that loan with them being managed by them with that bank. So if you down the track decided to refinance, you went to another mortgage broker, went to another bank, it would then come off their book and they're no longer being paid.
Yeah, so while we're on that, another reason why some people do pay or charge fee for advice is that in the first 2 years, if that loan is refinanced with someone else or by the bank, that,
or you sold the house and the loan was paid out.
Any of that. If the loan's paid out, the broker, the money they received is 100% taken off them. So
yeah. So this is kind of why brokers are like, well, what's the plan with the property? If you were like, oh, I'm buying and then I'm selling it in 6 months, or I'm doing this, they're probably like, well, it's going to take a lot of work for me. I'm going to get paid and then I'm going to have to pay that back. So you need to, and maybe they'd still do the loan, but maybe they'd charge you differently for it. I think it's really important that, because these people need to get paid, right? Like it's a job like anything else. So we want to make sure we do the right thing. But then you also, if you think about, like from a broker, from an incentive perspective, they want to look after you. So if you're thinking, you know, oh, is this the best rate, or should we do this? Yeah. Go to your broker, because they're being paid to work for you. Mm-hmm. So they're going to actually want to help you and keep you in their books. Like you don't need to go and check, like if you're not happy with your rate, you wouldn't go and see another broker unless you're not happy with that broker, right? Yeah. You'd go to them, they're being paid, they want to keep you, they want to help you service and retain and get the best out of your loan. It's in their best interest, and they care about their clients in this case.
Yeah, and at the end of the day, we know your situation, so that just means that there are ways of strategically moving the next thing that you do that makes sense, rather than not realising and doing something and then it kind of, you know, tripping you up 12 months later going, oh, damn, could have done that differently. So
and that's, so my background's financial advice, obviously. So I think that's really important, that when you buy the house or what you take any step in your financial journey, especially like a big decision like buying a property, you need to think about what are the next things that you're hoping to do. And yes, that might change, your plans always change, but whatever you do right now, you don't want that to have a knock-on effect that it stops you from doing the next thing. So if you can, you want to kind of think of the big picture, which a broker can help you do, rather than going, what's the quickest way I can get into this loan with the lowest interest rate? You know, the broker might be going, well, your plan is to do this, so this loan structure is more important than the interest rate, or having this offset, or having this and these bells and whistles. Whereas if you went online, you might get a much cheaper rate at a bank, but it doesn't have any of the facilities that you need. It's really restrictive. You know, you can't pay extra. There might be lots of things. So you want to think about whatever the loan you're getting, that it's not going to stop you from doing the next things. So big picture strategy, and that's why they call it advice, right? Like it's advice. It's a professional service to make sure that you get the most out of it.
Yeah, definitely. For example, I had a customer who was doing lots of different things, and they'd just finished building a house and they were going to hold on to this house and rent it out. And then they had another land and build that they were doing, and then there was a few changes in maybe changing employment, but then they were going to go, there was lots going on, and they had an offer too good to refuse. So they ended up selling the house that they'd just built. Now, generally speaking, you know, they would just pay that loan out and then move on to the next. But they had all these things going on, and then they had another opportunity pop up, and we didn't have time to get finance approved and ready to go, and they might have been out of the country. So there was all of these things, and for me to understand, lots of moving parts. So for me to sit down and actually have a look at this, I was able to successfully recommend what we call a substitution of security, and that just meant that we got the money, we made that the new security of the loan that was technically going to be paid out, and then they were able to use that to purchase new land, and we just swapped the security over.
Well, that's actually probably a good segue into a question we've got from Joy, and it's, what do you recommend with buy then sell or sell then buy? We've just had a baby, we're looking to move from our unit into a family home in the next year and don't know what the best financial decision is. So this, I love this question because I talk to people about it all the time, and really, really importantly, this is not financial advice from a financial advisor or a mortgage broker, because it's really specific to your situation. But I think this is a question that lots of people ask. So rather than answering Joy's question for what should she do, I want to talk about a couple of different strategies.
Yes.
Okay. So one, I find, and you might be totally different, but I find Australians, and it's probably the generations before us, how they were, are very much like, buy the house that you want to live in, focus on paying it down, just focus on that, focus on nothing else, and own the house that you live in and live in that house forever, pretty much. And we see this when we see like baby boomers that have lived in the same house for 40 years and they don't have debt, and maybe then their only other asset is their superannuation because it was compulsory. But the other thing that we see is most people, I find, again, generalizing, will go, right, well, based on that, based on what our parents did, they always owned the house they lived in and they focused paying that down. So if people are upgrading their houses, they're generally selling the first one and then buying the next one, paying down more into that, and they're slowly upgrading till they have the dream house. Then they retire and then they downsize. Whereas another strategy is if you were to buy your first property with an investor hat on, not a homeowner hat, not the emotional, not the this is where we're going to raise our kids, like an investor hat on, you would go, well, this serves a purpose right now, and looking to the future, does it make a good investment that it would be worth us holding on to? Would somebody else be okay to live here, so that when we're ready, we've outgrown it, can we keep that and can we move on to the next and the next? And then you maybe have a trail of, you know, 1 or maybe 2 to 3 properties behind you that at some point when you're in your dream home, you might decide to sell them and pay down your debt. You might keep them and have income streams. I think people automatically go to, if we want to do the next thing, get into the bigger house, we have to sell the first one, which is not always, if you plan it out ahead, I think there's potentially better ways to do it, but it depends on a lot. What do you think, without being advice?
Yes, no advice, but I totally agree. I totally agree. But everyone, and again, everyone's situation is unique. So it all comes back to what your borrowing capacity is going to be, what your lifestyle is going to be, if you're having family, how much time are you taking off work, cash flow, you know.
Sometimes you'll be in a position not to actually be able to retain a house. Sometimes you have to sell the next one.
Look, I totally think that if you can hold on to your property, then you're paying stamp duty. So each time you buy a property, if you calculate the amount of times you pay stamp duty and add all that stamp duty up from the buy and sell.
And then you've got real estate agent fees, like that's
the agent fees,
like 15.
That's it. So if you were to look at that over a period of time of you doing all these different transactions, to look at what would it have actually cost you to actually hold.
Yeah, but it has to be the right property to hold. You know, it has to be worth it. You don't want to be paying a lot outgoing on maintenance and all of that kind of stuff. So I find that a lot of people, God, I'm generalizing a lot today, sorry. But yeah, I find a lot of people that have investment properties are accidental investors, what I would call them. And it was because they bought a property and then they outgrew it and they've just kept it. So it was accidentally an investment property. It wasn't their decision to go, right, this is our stepping stone house. This is good for us now and we want to keep it as an investment. Yeah.
So with Joy's question, I'm just going to say I was in a similar situation. My first property I bought was a unit, and then we upgraded to the bigger home, and then I actually moved back and tried to live in a unit with 2 young children, which ultimately realised I couldn't
tear in your hair. I
couldn't do. But unfortunately I went through a divorce, so I was at that position where I had to sell my unit. But if I hadn't have gone down that path, you know, to look at what the value of that unit is now, even 5 years later, is significant. And even, you know, selling my house, the value of that is significant. So I would be debt-free today, completely debt-free. If I chose to go, I don't want a mortgage and I'm going to sell, or you continue on having that debt over time, as you said, you build and you buy and you continue on. If you can manage that, then long term, it's going to be an uncomfortable for a lot of people debt amount. But if it's serviceable, you just got to factor in the money that you're saving through the buy and sell each time.
Yeah.
But totally. It's if you can do it and hold on to it, and it's the right investment, as Gemma said, not all are.
Some properties you don't want to hold on to, right?
Well, here's the scenario where it doesn't really make sense. And again, I'm not an accountant, but when I sit down with someone and we look at the property they're buying, the first thing I ask them, and it's their first time, is, can you see this being a good investment property in the future? Or is it merely just getting in because this is what you can afford, but it's probably not going to be the best investment? But if they've got incomes that are going to continue to grow, so they might be at entry level, but they know over time their income is probably going to increase significantly in the next 10 years. This property very well could be an investment. And that's where we have the conversation around what type of products and offset accounts and things that we talk at that point. Because when that day comes and they keep that property, it does serve its purpose from a tax point of view. And for a lot of people who didn't have that conversation but were in a position to put a lot of money and pump it into their home loan and pay it all the way down, that person who chooses to move out and get the next property potentially may not have the greatest investment property because they paid the debt down. And one of the advantages of having investment properties, growing it is, the tax advantages of, deducting that and
well, that's what happens when you become an accidental investor. Usually you've got why it doesn't work is because they'll have a smaller loan on the investment property, so they're not getting all the deductions, and they've got a higher loan on their house, which is not tax deductible at all. Whereas ideally, if it was in a perfect world, you'd want those switched. So that might be a reason that people sell as well. It could be, it's not going to work tax-wise. It's not a good investment. It's going to cost you more than, the growth. It's got a lot of maintenance and stuff, or it's not in a great area. Or like an example in the chat right now is we literally can't afford to keep that property. But, selling it, if you've lived in it, there's going to be no capital gain. So yes, there's going to be stamp duty on the next house. You're going to pay agents' fees. But it's a fact of life. Most people will have to do it that way. And I don't think it's necessarily a bad thing. All I would say and this applies to any financial decision, it applies to actually probably any decision ever in your life, but whether it's buying a house, online shopping, bungee jumping, whatever, just because you can doesn't mean you should. So when I talk about that in relation to buying a house, just because the bank says you can borrow X amount doesn't mean you should. Just because you can get the massive house doesn't mean you should. Is that going to stop you doing the next thing? So I would love to live in a huge house and have the dream house and things, but right now building financial assets and wealth outside is really important to me. So I think it's just balancing, where can you afford, where will you love living, where does it make sense, but where's not going to stop you doing the next thing. Just because you can doesn't mean you should.
Well, getting the huge house, then you've got to have the money to maintain the huge house.
Yes.
So it's all of
and the time to do it, and then your rates go through the roof. So actually, that's a really, really good point, because we're talking about investors or the next property, right? It's not always first home owners. So if we focus on that, one of the big things that I think people don't consider, so when I do money coaching, we do cash flow and budgets and stuff, they go, oh yeah, we've got to afford the new repayments on the big dream house, but they don't think, well, now we've got a pool, so that's a massive expense. Now we've got these gardens, now our rates have just doubled, we've got to pay for the electricity in the house. So they don't actually think about all those knock-on effects.
Can I piggyback that? Going back to that first question you asked me about what can you do with the credit report, the second thing I was going to say is understand what your expenses are now, but then start getting ahead and do the research around what they will be on your ideal property. So a lot of people complete their information and they do their expenses as what it is, but you've got to think, you've got to
even your insurance is going to be higher,
the insurance, all of that.
So it might actually say, you might be paying less in maintenance because maybe it's a newer property or something, but all of those other things you've got to think about, the knock-on effect as well. Yeah, cool. Okay. Well, we've got 3 minutes left. Wow, this has flown by. I wanted to finish on what's your biggest tip. So let's not talk about first homes because you've already done that. But what's your biggest tip for like an investor that might already have one property or might have a couple, or what's something for maybe a more sophisticated property person that you think's not talked about?
Okay, so one thing that I try to educate a lot of customers who fit this type of space when they become more of a professional investor when it comes to property, or not just property, but
so not an accidental investor. They're kind of strategically doing this. They're building their wealth. They've got their first home. They might even be in their dream home. Yeah, that kind of stuff. Yeah.
So ideally, like, you know, the property investor that continues to buy and finds ways of, you know, taking advantage of all the tax breaks. And the tax breaks are, if you're building a new home, it's the depreciation, you know, you're saving on the stamp duty because you're buying land and so on. One thing that I used to do a lot of back in the day when I looked after high value clients at Commonwealth Bank in Melbourne, that I don't do a lot of now, is interest in advance. So there's people out there who are on high incomes, or maybe they've got a massive bonus that's coming in at the end of the year that's going to really create a massive tax problem for them. They may have just done an investment or bought an investment property, or maybe they're about to embark on the next investment, purchase land and build, or not. So interest in advance is where the bank will allow you to fix your home loan for 1 year. So it's a special discounted rate, so it's better than the rate that everybody else gets. And basically what you do, you've got the money available in your savings. You can prepay that interest for 12 months. And that becomes a full deduction off your this year in the current financial year's taxable income.
So for example, it's May and the new tax year is going to start in July. You could be like, wow, my income's really blown out. I'm going to have a tax bill. I'm going to talk to the bank, fix my loan from May now to May next year, and I'm going to ask them to prepay the whole 12 months interest, so they don't charge it to me each month. I'm going to pay it all now, and then because I've paid it this financial year,
correct,
then you can claim it as a tax deduction.
Right. You can't obviously claim it the following year because you've already claimed it.
Yeah, because it's the time that you actually paid it, whereas if it's charged monthly, you're claiming it in whatever months it falls in the...
But you sit down and map out what are you doing in the next 1 to 2 years. If you know your income's at its all-time high, but perhaps you're not going to work as much next year, or you're taking a holiday, or for whatever reason, you know you're going to pay the biggest amount of tax, but you do have a goal to buy a property. Like, these are the things to chat to someone about.
I actually, when you said that before, I haven't thought about interest in advance in years, because I used to do loads of stuff and hadn't even crossed. Nobody talks about it anymore.
Well, once upon a time, it was like crazy. In
Everyone
May, June, we used to get all the clients pumping in at the last minute going, I've got to do my interest in advance, I've got to do my interest in advance. And it was, obviously, you know, resolving a tax issue for that client in that year, but also getting a good rate on your home loan. Obviously, it's fixed, so you can't break out, well, you can break out of it.
Yeah, so there's so many things you need to know. You know, you're definitely keeping that property so you can fix it. It's strategic because you need more expenses this year. So you talk to your accountant, you talk to your broker, you talk to your bank, all of that kind of stuff. But yeah, that was one that we talk about lending all the time, and you always see like strategies, people talk about them, but I haven't heard of that one in years. So I love that you brought that up.
Yeah, cool. So that's my investor tip.
Awesome. All right. Well, thank you so much for joining us, and thank you for the people that put stuff in the comments. Again, anything that we talked about is not advice. You need to get specific advice, and the people that you would go to is your financial advisor, your mortgage broker, your accountant. These are the A team that you need to surround yourself if you're going to make smart decisions in finance and property. So if you'd like to get in touch with Emma, it's Emma Stevens at Mortgage Choice. All right, so I will be back next week with Lexi. Lexi will be back, but thank you very much.
Thank you for having me, and I'd love to chat if you need.
Bye.
Bye.